I know there's some decreases expected at some point in 2024. Personally, I don't think they'll happen as early as people are hoping.
Yep.
But the sentiment is that things are turning around and 2024 hopefully going to see a decrease.
Welcome to The Flow, real estate and money show for people in Canada looking to understand the home buying process, to demystify real estate investing, and to make mortgage financing accessible for anyone. The goal here on this show is to help people understand ways to make their money work for them, get in the market sooner, and realistically, completely open up the box on how mortgage financing works. I'm Alex McFadyen, your host, and I can't wait to help get you into the flow. All right, that's it. The BOC again held interest rates. We're just going to say that right off the bat because we don't want to keep that level of suspense for this entire episode.
Yeah.
This is going to be a fun episode because we're doing a solo cast, and we got a lot of feedback from people who wanted a solo cast, and we got even more feedback from people that they wanted to bring on. Actually, I'm lying. This is not a solo cast. What am I talking about? Where's a dual cast, and we're bringing on Matt Coltira.
Ooh, first pod.
First podcast. Matt, what do you do, Matt?
Whoa, I am an associate mortgage advisor here at Flow Mortgage, supporting all the clients and realtors that we work with.
Yep, absolutely. Yep. All that. But you do more than that. You got a lot more going on. Tell us a little about your background, buddy.
Well, I've been in lending for a little bit now. I started right out of college. I actually started underwriting at Canadian Western Bank in the equipment finance department.
Yeah.
And then from there, I actually started brokering on the equipment finance side with a good friend of mine. And then one thing led to another, and found myself wondering what to do with, layoffs and COVID, and mortgages seem to be the answer. So
place to go.
Here I am.
Right on, man.
Yeah.
We're happy to have you on board. So excited to have Matt on the show here today because Matt's going to bring a little bit of a different perspective. He sees hundreds of files. Well, he's seen over 100 files actually already with Flow, notably just last week, I think.
I was going to say 100th file last week.
Nice. Okay. So we hit a big stage, and so you have a little bit of a different perspective being in the file, and you can bring your color to a lot of this. So I think people would love that really just a different perspective. So guys, today, of course, we all know that the BOC that kept interest rates at the overnight rate of 5, but it's not about necessarily just that. Today's conversation is going to be realistically, what are the echo effects? Like, what are the ricochet effects of that? And what are some of the predictions that are coming out in terms of interest rates? How will that impact the market? And what are we seeing as far as what's happening in the current market right now? Just so that the folks out there in January and February can really get a dig into what they should be considering doing and where some of the opportunities are. So that's what we're going to do today, talk a little bit about that. And more importantly, really just a little bit of a roundtable conversation so that we can keep things fresh around here, hey?
Awesome. Let's do it.
Let's go. So specifically, the Bank of Canada kept the key rate at 5%. The key rate is obviously the rate that drives prime up or down. As we know, most Canadian borrowers are breathing a heavy sigh of relief.
Oh yeah, big time.
Yep. How many times a week have we heard for the last, 6 to 8 months of people being very stressed out, trying to figure out what they should do when it comes to variable rate mortgages, right?
Yeah, it seems like we might have a little bit more clarity now, hopefully. That's a sentiment at least.
Yeah. I mean, let's hope so. So what actually happened, the reason that the bank kept interest rates at the 5%, we talk about these things, or at least I talk about on a regular basis on Instagram and so forth, is we're actually starting to see the economy turn around, right? We've noticed that, we've observed that GDP is not in a great spot, so gross domestic product. We've also observed that unemployment is on the way up right now. And in addition to that, we've also observed that, it's actually starting to work its way into the economy in the sense of lower spending. So we're seeing a little bit lower spending. Inflation is starting to kind of find a little bit of a level playing field, but it hasn't worked its way all the way through, right?
Not quite yet.
Yeah. So, as far as how this impacts people, let's just unpack that really quickly here and talk about it. I'll just jump in really quickly. First and foremost, anybody who has a variable rate or a line of credit, you're still experiencing the same pain as you had before, right?
For sure.
If you are in a position where, I think the only thing I've heard from people is if you're in a position where you're in a variable rate with a TD Bank or RBC or CIBC, where you had a locked in variable rate, still people are starting to get those trigger rate emails.
Yeah.
I don't know. Do you want to dig into that a little bit in terms of like the trigger rate, and have you experienced people?
I haven't experienced too many people acting on the trigger rate. It's a lot more like, what do I do? What does this mean? I think a lot of people, it was experienced early on when we had those really quick, rapid increases. more so now, the rate's been held for the last little bit. I think, was it back in the summer, there was that 25-point increase. I think that kind of signaled to people that, exactly kind of where we are. They expected that after that 25% or 25-point increase that things would settle down. I think there was a little bit of an increase perhaps priced into the market for this last meeting, but we're fortunate that it didn't happen.
Yeah, and you're like bang on in regards to like earlier in the summer when we had that increase was when we had everybody obviously reaching out, stressing out because the bank letters were coming in left, right, and center, and like every bank's letter stressed people out so much that we would get calls. Oh, what do I do? What's going on? Am I going to lose my mortgage? And obviously the headlines were like infinity mortgages, lifetime amortizations, and stuff like that. You're right. I felt like a different feeling this time. Like it was a different energy in the air. And it almost felt like this, not just a sigh of relief, because I think that was probably the October one, but it almost felt like, okay, cool. Like we're at the peak. I kind of got that sense, right?
Yeah, a bit of a pivot. I think people are kind of expecting maybe not early 2024. I know there's some decreases expected at some point in 2024. Personally, I don't think they'll happen as early as people are hoping.
Yeah.
But the sentiment is that things are turning around, and 2024 hopefully going to see a decrease from the Bank of Canada.
Absolutely. I couldn't agree more. You're absolutely right. And so what is the Bank of Canada actually looking for to provide some level of decrease? The first thing, and one of the most important things is looking forward into January. Mm-hmm. December's a big month, as you know, for inflation. Like everybody's out there spending money, buying TVs and I don't know, whatever stuff they buy for Christmas. Like there's a lot of spending going on right now, consumer spending, and credit card bills are racking up right now. And so I think that one of the big things, and I don't just think this, we know this for a fact, that the BOC or the government is generally speaking going to be looking at what the inflation numbers look like when they come out in January.
For sure. To
reflect back on this December.
Yeah.
And see where it's at. Now, what's interesting is like a lot of people that are out there are looking at, if you watch a lot of the YouTube videos or look at a lot of TikTok, it's a lot of naysayers, a lot of negativity, a lot of people thinking that like everybody's going to go bankrupt and everybody's going to foreclose. I mean, on my side of things, we are seeing some pain.
For sure.
And there's definitely some tough situations that are out there at the end of the day. But more than anything else, I've noticed that I think people are just kind of just taking a step back.
Yeah.
What are your thoughts?
I'd agree with that. I think a lot of people are kind of taking stock of where they're at currently.
Yeah.
And we're having a lot of those conversations. Like, where do I sit now, and where do I need to be to make the move that I want?
Totally. Yeah. And so with that being said, of course, we are seeing some people in some tough spots. So one of the things I've noticed is that there's a lot of commentary out there and a lot of communication around there being, people that aren't able to make their ends meet. There are conversations around people having like infinity mortgage, like we talked about earlier. And there's no doubt that's true. There are people in some tough spots, and we're seeing a lot of it obviously in Ontario, Toronto, and some people out here, but it seems in conversation like it's not as prevalent yet as people are making it out to be. Have you noticed that?
I'd agree. I think it's taken a little bit longer than people anticipated to kind of work its way through into the market. Like I think probably over the last maybe 4 months, that's really when we've started to see a decrease in, consumer spending, which is kind of reflected in some of the numbers that we're seeing being put out by all these kind of data houses.
Yeah, all the publications are definitely showing that. And I mean, there's definitely, obviously, like we said, going to be a lot of consumer spending around Christmas time and so forth, and that's going to pick up. But one of the things that people often forget when it comes to these types of conversations is that just because inflation's cooling down, we're still in an inflationary measure from a perspective of wage growth. Mm-hmm. And so what I mean by that is the wage growth numbers came in, and I'm just looking at this right now, and Matt, they came in at 4 to 5%. And there's a lot of reasons for that. There's still like this lag effect. And, employers and employees are kind of catching up a little bit to what happened. And until that actually slows back down, obviously, we're still going to see some continued inflation in the marketplace. So as far as like reactions, like getting back to the day-to-day anecdotal evidence, I mean, the first thing is I don't know if you've seen one yet, but I haven't seen come across anybody yet that's like desperate. They have to sell their house right now.
Not once, I don't think, actually.
No. And I mean, let's be honest, like we're seeing, we're talking to probably about 100 new people a month. So we've got a pretty decent sample size of people that we talk to, right?
I'd say so. I think it's more people are always thinking the worst case is happening more frequently than it is. And like you just said, like from experience, at least what we've kind of encountered here, I personally haven't worked on a single file where someone's been forced to sell.
Yeah. And I think like There is probably some truth associated with the fact that a lot of the pain from the rate increases probably hasn't hit yet.
Mm-hmm.
I mean, there's some truth to the fact that rate increases, it's suggested that they typically take almost a year to work their way into the system. Now, based on that feedback, I think the first rate increase happened in 2022. And what was that? Was it April or March?
I want to say it was April.
April, March. Okay,
Right
so
around
April.
there, spring.
Yeah, so the spring of that year. So that would be about a year later that it hit, and that would make sense. So we're talking about 2023. And obviously, we saw the real estate market die all the way down for a period of time and pick back up in the spring of this year when rates went back down. But, we had rate increases all the way up until July of this year.
Yeah.
And so based on that presumption, it would be logical to assume that we probably haven't even felt the worst of the rate cycles, and we're probably still 6 months out from that level of pain. So I'll be curious to note whether or not, people are in a position where they can't hold their homes. There could be a few people that are there that are squeezed from buying in the height of 2022. But I mean, I just feel like people will pay their mortgage before anything else. And it's just probably not going to be an issue that we deal with so many foreclosures as they're predicting, right?
I'd agree with that. I'd say the first things that people are going to kind of avoid paying would be those small bills, like credit cards, or not necessarily every credit card small, but like phone bills, those small credit cards. But most people are going to do whatever it takes to keep a roof over their head. And I think we've seen that.
Yeah.
Just by the fact that we haven't had anyone come to us and say, I need to sell my home.
Totally. So let's talk about so we know what happened with the BOC. We know they kept the rates the same. Let's talk about some of the predictions that came out. And so we've had a few predictions that came out. I'm going to pull up a little bit of a chart here. Obviously, you're the podcast, you can't hear this, but most of the major banks published a chart they published their predictions based on their major economists for the year 2024. Now, here's the thing. And we know that economists are economists, right? They get paid to be right half the time, right? So 50% of the time. And we've been watching the naysayers say since 2009, be ready for the potential collapse of the market, right? So, I mean, you tell me, but I don't think we're in for a massive market collapse. But do you recall any of these predictions and just like general thoughts on when you saw them, what your feelings were towards them?
Yeah, I've seen the predictions. I mean, prediction is just that, a prediction. You got to take it for what it's worth. It was initially predicted that rates would be low until the end of this year, and look where we are. So keep that in mind whenever looking at a prediction from some of these guys.
Yeah, no doubt. That's absolutely the case. But let's go through these. I'm just trying to find my chart here really quickly to actually walk through what some of these numbers are. But yeah, so basically here's what the numbers are for anybody listening that wants to know what's going on in terms of the big bank rates. So we've got BMO that's suggesting a target rate by the end of 2024. They're suggesting a 0.5 point. So they're the most conservative of all of the big banks in terms of their predictions. And that's the end of the year 2024. By the end of the year 25, they haven't provided that yet. And I mean, ultimately, there's a few other kind of different variations that they provided, but that's kind of where they land on their side of things. The target rate at the year end 24 CIBC, they're suggesting 3.5%. So they're thinking about 1.5. So they're definitely on the most aggressive side. I mean, that seems really interesting. That's Benjamin Tal, who is pretty widely regarded as far as the information that he puts out there on a regular basis. Hey,
for sure.
We're looking at NBC National Bank, 4%. So a 4%, so it's a 1% reduction within the next year to overall interest rates. And just so you guys out there know, that is equivalent to an 8 to 10% increase in borrowing power. So interesting to note that. And for every quarter point, we know that's about a $15 roughly difference in payments for every $100,000. So $60 in a year per, and then if you're borrowing like $500,000, which was our average loan amount for years, that's a pretty significant difference. $300 on the monthly payments that is going back down in 1 year.
Yeah.
And so it'll be interesting to see if that happens. We got RBC, 1% reduction is their proposal. Scotia, they're suggesting a prediction of another 1%. And then TD again matching CIBC with 1.5% overall predictions for 2024. Thoughts?
Yeah, I think some of those are pretty aggressive in my mind. I'm more partial to think they're going to keep it status quo for a little bit longer, just for the reasons that we touched on earlier, that it takes a while for these increases to make their way through the market. And I think given any unexpected events in the world or in the economy, I'd expect that rates will probably stay where they're at, probably till the last quarter of 2024.
Okay, all right, interesting. So
that's my hot take.
Yes, that is a hot take. So I mean, obviously you're probably more in line with the BMO prediction here from that perspective, about 0.5% by the end of the year. And you might not be wrong, because ultimately Tiff Macklin came out in, I think this was a few weeks ago now in November, not to date this too much. And he said that essentially they're going to try to avoid what happened in the 1970s. And in the 1970s, for those who don't know, they went through obviously a massive inflationary crisis. They increased interest rates, but then they dropped them before, I guess, the economy was fully recovered at that point, or to a point where inflation was cooled down. And then essentially it bounced up, which is why you dealt with what you always hear if you're listening to boomers,
Yeah.
the early 1980s, which is where we had that massive spike in the old 18% interest rates, right? So basically, ultimately, I mean, my thoughts on the matter is, CIBC's 1.5% reduction. I think a lot of this obviously comes into, what is that delay? What is that delayed cycle? And how bad is the impact that we see in this April timeline? The market's pricing in quite heavily right now the first rate prediction to be in April of 2024 with almost like 100% certainty. Like that's how much, that's the degree of confidence that the market is pricing in a rate drop by a quarter by April. But as you just suggested, I mean, or we both talked about there's a very good chance that could be delayed. And the number one reason I think that could be is actually real estate and mortgage related costs. To be more specific, and Matt, I'm not sure if you saw this report, but there was a report out there that showed that, and there's a lot of reports actually about this that talk about this. If you actually look through and break down like what comprises inflation, the number one cost in costs is housing.
Mm-hmm.
So rental rates, and mortgage rates. So I mean, like, I don't know, given that feedback there, it seems that it would make sense that inflation's going to be pretty high for a little bit longer, given that feedback. Your thoughts?
I'd agree. I mean, look what the last year and a half, 2 years has looked like. What have you seen very significant increases on? Mortgage rates, rental rates. And if they're making up a big portion of that bucket, that's kind of why I'm more leaning towards a decrease closer to the end of the year.
Yep.
And I think, I think the Bank of Canada recognizes that as well.
Yeah. And you're probably not wrong from that perspective. In the meantime, while we're talking about this, today's implied rate forecast, which is, it is based on a certain day and time, and this can change any time right now, is that we'll see interest rates decline. The implied rate forecast is that we'll see a 1% dip by the end of the year. But again, as of course, April of this year being where most suggestions are coming in, that there's going to be a 0.25 point dip. So, I mean, we'll obviously wait and see. I would be leaning more towards the 0.75 to 1% range, and that the 1.5 is very aggressive. But the one thing that I'm always reminded when I'm listening to a lot of these forecasts from a lot of the economists, if you look back at history, is that typically speaking, like when we have to drop rates, we have to drop them fast. Mm-hmm. It doesn't really just happen like a slow little drip down like we want them to be. So it's almost like, I almost expect that they'll probably hold longer and dip them really quickly because of some unforeseen event, or things are way worse than expected. And so that'll be an interesting consideration. Let's talk for a second about fixed rates. What have you noticed lately in the fixed rate space?
Well, they are definitely coming down a little bit. And I'd say the last couple of weeks, like fairly quickly, like we've gotten quite a few emails from lenders on rate drops, making some nice calls to clients, advising them of these rate drops, which is always fun to do. Hoping that trend continues into 2024, and it kind of looks like it might.
Yeah, you're right. And to that point, what I found really interesting about that was that rate drops have occurred, obviously, if for those people who don't know this, is that typically speaking, fixed interest rates follow the bond yields in the bond market. And without going into a long conversation, we'll have a separate piece on that. Basically, what we've observed is that we've seen almost a 1% decrease in the bond yields over the course of the last 4 weeks.
Yeah.
And that should correlate in 1% rate reduction, you would think. But it hasn't. It hasn't at all.
Not quite.
I've seen it, for the most part, about 0.5%, roughly, maybe a little more.
I'd say so. I like just using a client's file as an example. We had one file, 6.11% reduced down to 5.91%. So not nothing for sure.
Yeah, about a 20-point dip, and that was in like the last 2 to 3 weeks. But it should go without saying that when the bond yields dip, the banks are typically speaking more willing to negotiate. And we've noticed that from a pricing war perspective, hey?
Absolutely.
Yeah, we're seeing them be extra aggressive. The banks are kind of playing the rate game. Frustrating from a consumer perspective too, though, because ultimately, and you, I'm sure, can speak to this as well, they're not really offering terms up front. They're kind of playing the, hey, go find a rate and come back to us game.
Yeah, they're willing to match it or undercut it by a couple points, maybe a little bit of cash back here. but definitely not super forthcoming in what the rate will be
Yeah.
right at the onset. They kind of want to see what other brokers or other lenders are providing, and then doing what they can to win that business.
Yeah, and I mean that's got to be so. We know this is super frustrating from a consumer perspective because obviously they're not really being proactive, and if rates go down further, what do you got to do? You got to go out there and obviously source some more rates before they're going to be willing to do that. And I think we actually been interesting because lately we picked up a lot of business because of that.
Yeah.
People are like, hey, I just don't want to work with these banks that are doing this back and forth game because we obviously proactively get the rates dropped anyways, right?
Absolutely.
So on that note, so speaking of where the value is right now, this is a super interesting conversation. Like, what are some of the rates that people are taking? And then obviously, what's the impact of lower interest rates in the marketplace? Obviously for the last, 4 months, the most common rate has been in what, like term on your side?
2 or 3 years, I'd say.
Yeah, I would say definitely a 3-year fixed, right? Like everybody is like 3-year fixed, 3-year fixed, 3-year fixed. And we've seen that in the pricing in the market. Banks have been more aggressive on the 3-year. It seemed to make sense because the forecast was like, at the time, like 2026 is when you'll likely see interest rates come down. It's for most people that gives them that like sense of certainty. But there's been a crazy shift lately. I mean, I've noticed about yourself.
Yeah, I'd say with rates kind of expected to come down at some point in 2024, like seeing a lot more competitiveness on the 5-year fixed.
Yep.
Like the decreases on the 5-year side, you're seeing those below 6 now, which is interesting. We haven't seen that in the last few months. And a little bit more interest on the variable side as well.
Yeah. And to be clear, below 6 on the uninsurable side. So that's a 30-year mortgage. On the insured side, we just saw them break the 5% barrier. So we saw some 4.99% rates, which are crazy. An insured mortgage, again, is one where you're putting less than 20% down. Or if you had a mortgage with less than 20% down, you can transfer it to that type of product. But, and Matt, I'm sure you'd agree with this. Like, I would run from a 5-year fix right now. Like,
yeah, it's not something that I would personally take on, just given what we're expecting to see in the market. But I mean, that doesn't mean that your situation doesn't warrant a conversation about it, but it's not the overwhelming majority are interested in that term right now.
Yeah, and for good reason, because like if we looked at the forecast, which the rate forecast market right now on this market is essentially that we're going to see at least that 1% drop. Even on the fixed rate side, there's a proposal that we're going to see somewhere between 1.5% to 2.5% over the next 24 months. Like, why would you lock yourself into a 5-year fixed mortgage rate at 6% when you could go into, like you mentioned, I know it's scary and a lot of people don't like it, but a potential variable rate mortgage where you can slide back down and hypothetically, and within 1 year, you match that rate, let alone the rest of the 2-3 years of that term, right?
Exactly. Now you pay a bit of a premium now, just kind of getting in on the variable a little bit earlier, but then you kind of ride that wave down as opposed to 2 years ago when you were riding it all the way up.
Yeah, no, it's so true. So right now, I mean, it's probably a healthy mix of mortgages that we're seeing. 2 years, we're still seeing some 3 years, and we're now starting to see. In fact, I think the last 3 or 4 were variable rates that we did recently, specifically adjustable rates where the payments go down.
Yeah.
Because a lot of people right now, they're like, heck, I want to take those stairs down if we're going down, right?
Absolutely.
I'm tired of being on this top end of the wagon, so to speak. So with all that being said, I mean, some of the impacts of what happened here recently and some of the things that we've noticed are, and we've talked about it, are obviously the rental rates and what's happening in the marketplace and how that plays a role in all of what's going on. And more specifically is what could happen if rates, stay a little bit lower and move forward in the next little bit. So, I mean, I'll just give my piece really quickly here. Like, first and foremost, we've seen a lot of studies that have come out recently. Rental rates are they're just going up everywhere, through the roof. And the cost of renting is going up at a substantially higher rate than the cost of buying, contrary to what people think. Mm-hmm. So if you can get into the market, it's just another reminder of the opportunity that presents itself, assuming you're not paying some, antiquated $1,000 rent from 4 years ago or something like that, right? The other note on that was, well, there's a lot of like conflict about where the market's going to go next year. We saw obviously a 1 point drop in the bond yields, but of course that could bounce back really quickly, and we could see that shift up, especially, if we're waiting until April or the fall, like your prediction is on the rate side of things. So I mean, what are your thoughts here? If you were to kind of forecast January, February based on that, based on people coming up for renewal, like what do you think that the rate change or lack of rate change today is going to do for the market over the next, say, couple months?
That's a tough one. I mean, in terms of with the market, I think we're just going to see a lot more people open having a conversation, just wanting to see where things are at, just knowing that, this cycle of increases is over. a lot of people were on the fence for the last 2 years. They didn't want to jump into the market while things were kind of climbing. And they kind of wanted to see that signal that things were on the way down before having any conversation. So I think a lot of these people that maybe were willing to put their what's the word I'm looking for, their hand in the game, I guess, you're going to start seeing those people come back.
Yeah. You're not wrong in that perspective. I mean, there's no doubt that we're probably going to see some people that are squeezed because of the higher rates for an extended period of time. There's definitely going to be probably a mix of some pain in there too. And you're going to see some renewals where people, even if we refinance or restructure them, there's a little bit less money in the pocket. But the one thing I always try to remind anybody about the real estate market, even the worst when they talk about crashes, is like there's always a pricing floor in Canadian real estate. Historically speaking, like Canadians have such a strong sentiment for real estate as an investment, but also their home. And the thing is, like, when there is positivity in the marketplace, so when we see, hey, rates have paused, you know this and I know this, typically speaking, 3 weeks later, guess what? We get a lot of calls, right? Yeah. It's just like this mental game. More so, if rates were just to go down that 1%, even on the fixed or the variable rate side, that minimum qualifying rate, as we've talked about, goes down, which means our clients' borrowing power or listeners' borrowing power goes up by, as much as 8 to 10% range, right?
100%. And I'd go as far as saying too that there's a lot of those people that were unwilling to look just because they couldn't qualify for the property that was going to meet their needs or the property that was going to, achieve those goals that they set for themselves. And I think with the decrease in rates, that qualifying rate going down, it's going to open the door for those people to kind of get into the market at the price point that they were initially after. Yeah,
that's a good point. And I think even more so, like one of the reasons that people didn't buy this year is because, hey, I got a 2% rate. And now what's going to happen is they're 1 year closer to being up on their term. It's not as big of a leap from 2% to 6%. Maybe it's 2% to 5%. And they might say, well, I only have 1 year remaining. Okay, well, whatever. I'm going to go ahead and see if I can make that move. And so for a lot of people, they say that that's going to be an increase to supply. Well, we still have an insane amount of demand, right?
Oh, for sure.
Yeah, we have hundreds of pre-approvals that are waiting to buy and trying to wait for the market. Anyway, I mean, I think that's probably going to be an interesting year. We're going to have the renewals coming up. We're going to have the uncertainty around rates, but I think we're going to have that positivity and lower rate. I don't know. Throw it in the pod. We'll figure it all out, right? Yeah. So it should be interesting. So anyways, I hope you guys enjoyed the conversation here around where rates are going. Don't leave yet. The only quick thing I got to ask for you is if you love the podcast, if you're loving the show, make sure to rate us. Give us a great rating on iTunes and Spotify if you're listening. If you're on YouTube, make sure to hit that thumbs up and follow the channel. Otherwise, we appreciate it. Give us some feedback. Let us know if you want to bring Matt onto the show. And we'll see you next time. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.